Hey you guys, it's Luke Newcomer here with the Newcomer Group. We're exceeding your expectation as our standard. And today, we've been putting a couple different segments together about real estate investing, and something I thought was super important because I'm personally doing it, we're helping people do it, was bringing Ben Platt on with Tembo CPAs. He is top-notch accountant, really savvy about real estate investing and helping you from a tax standpoint and strategizing appropriately. So we're bringing him on. We're going to do a couple Q&As with him, hopefully answer a lot of questions you might have about real estate investing and what the tax advantages are, the do's and the don'ts, and the things you definitely should be doing. So without further ado, Ben, tell him who you are, a little bit of background, and we can dive into everything.
Absolutely. Happy to be here with you guys today. Thanks for having me, Luke.
We're thrilled to have you.
My name is Ben Platt. As he said, my firm name is Tembo CPAs, Tembo. So a lot of people think it's Tempo.
Well,
it's Tembo.
Where did that name come from? Because I actually was like re-asking myself exactly what the name was.
So we were fortunate in our family to be able to spend quite a bit of time in Africa a few years back. And we fell in love with the elephants, and it turns out that the Swahili word for elephant is Tembo. So we decided to name our firm Tembo CPAs because the world doesn't need another CPA firm named after its proprietor. So,
like the Newcomer Group?
Like the Newcomer Group. No, just
perfect. That's really cool. I didn't know that. Anyway, didn't mean to cut you off. I needed to know that for myself.
So we started Tembo CPAs. We call ourselves the firm for entrepreneurs. So primarily that's who we work with, but that comes along with lots and lots of clients that focus on real estate. I've been a CPA for over 25 years. Really fell in love with working with entrepreneurs about 10 years ago. I've been involved in lots of ventures myself over the years, have lots of entrepreneurial spirit, as you know.
Yeah.
And we love working with people that are in all parts of real estate, from developers to, rental real estate to brokers and agents and everybody in between. So lots and lots of experience in that area, and happy to be here to answer some questions.
Yeah. And the cool thing is just, he's not primarily tax accountant for real estate, like you said. I mean, you work with all types of small business owners. And the cool thing is because you work with small business owners, which is why I thought it was important to hop on and talk to them. I work with a lot of small business owners. I am a small business owner, and a lot of small business owners want to park their money in real estate and do it appropriately from a tax standpoint for deductions, savings, and offsetting that kind of stuff.
Without a doubt.
And you do a really good job helping people with that, including myself.
It's a super important asset class. I mean, I'm a big proponent of diversification and building, your overall portfolio in all kinds of asset classes, but it's definitely a super important part of it. It's a big part of people's portfolio and net worth, especially when you consider their principal residence.
Sure.
So being real estate knowledgeable is important for all entrepreneurs and all people that own real estate, for sure.
Awesome. Well, listen, the objective of this video is to talk about the advantages for real estate from a tax standpoint. So it's going to be Q&A, it's going to be casual, but we want to get the word out and help as many people as possible to reference this video. So we're just going to dive right into it. I've got a list and a cheat sheet, but if we go off the cheat sheet to wherever, I'm good with that. So first off, in a nutshell, what are the tax advantages of owning real estate?
So I'll answer this in two parts.
Okay.
The first part is that real estate has certain deductions that go along with it that help you offset the income that comes from it. If you're doing rental real estate. From a broad level perspective, what I love about real estate is that you are investing in an asset that will appreciate in value, but you're able to take depreciation, which we'll talk about more in a minute, as a deduction against your income. So it acts as a tax shelter while you own an asset that is appreciating. Okay. So from a high level, that's why we love real estate as an investment. As we get more into the details, I mean, there's so many ways that you can capture deductions with real estate. Everything from obviously the maintenance and repairs that go along with it to property taxes and insurance and mortgage interest, and then of course depreciation. There's also other expenses that we like to capture in there when we work with clients that are running rental real estate portfolios. So, their travel costs to visit and maintain the property. A lot of times it's owned by people in the Northeast and they own property down here in Florida, or vice versa.
So they could even write off the trip down there?
Yeah, or at least a portion of the trip down, the portion that's associated with coming to visit their rental property and their investment, right? So those costs can be deductible. Even their lodging while they're here, if they're not staying in their own property, that sort of thing can be deductible.
Wheels are already turning with you.
I know, yeah. I mean, there's a lot of ways that you can capture the deductions. And from our perspective, one of the ways that we like to save clients taxes, whether it's real estate or not, is to identify the things that people are already spending money on
Sure.
You're already spending money on it. How do we make it deductible, right?
Okay.
So how do we document it that way? How do we set it up that way? How do we tell the story in a way that makes that expense deductible? Because then you don't have to spend any more money to get the tax deduction.
Okay, so let me ask, with deductions, basically explaining, hey, there's a lot of things you can deduct. What are the do's and don'ts of that? Because I think some people, you want to pay what you should in taxes, obviously. Be careful with that. That's why you partner with someone like Ben. But what are the do's and don'ts for deductions? Because I think some people get a little crazy with them, and then some people probably aren't taking advantage of what those deductions probably are with their investment properties.
Sure. So I kind of approach this from two perspectives. The first perspective is what the IRS says a deduction is, right? Any ordinary and necessary expense associated with the production of income. So when you're talking about rental income property, what does it take to actually generate rental income for that property? What are those expenses? So again, like traveling to see your property to make sure that it is going to generate income, that is an ordinary and necessary deduction. Property taxes, ordinary and necessary deduction. Mortgage interest, some of these are no-brainers.
So the taxes you're paying for that property is a deduction is a write-off.
That's right.
With that business.
That's right.
That's awesome.
Yeah. So those are write-offs. All of that goes to reduce the taxable income that you're receiving, the rental income that you're receiving, and results in either a net rental loss or a net rental income. And the other one that is really attractive is depreciation.
Yes.
So
now I just learned about this like a year and a half ago.
Okay.
You helped us with.
All right.
And I think a lot of people don't understand what that means, because when you hear the word real estate, you typically think appreciation.
Right.
And when you hear depreciation, you think of like going and buying a brand new car and driving it off the lot, and it instantly loses its value.
That's right.
So when we talk about, in a nutshell, the advantages of owning real estate, you've got the deductions with depreciating an asset. Definitely take the time and like simplify that for someone like myself, because that was a term I never really put towards real estate, and it's an amazing tool
It
from
is.
a tax standpoint.
Yeah, absolutely. So just to use the example that you use there, so with a car, everybody's familiar with driving it off the lot and having it be worth less than what it was worth 10 minutes ago. And that is the idea of economic depreciation, right? So over time, cars become worth less. From a tax perspective, the Internal Revenue Code allows you to capture that economic loss through depreciation expense, okay? And the idea is that you start with your cost basis. So this is a term that every real estate owner should know and understand. Cost basis is what you paid for your asset, whether it's real estate or a vehicle or this table. So whatever you paid for this is your cost basis. Over time, you'll recover a portion of your cost basis according to the rules. So like, for instance, with residential rental property, you're allowed to depreciate that property, the building part of that property, over 27 and a half years. So that's like, if you do the math, it's a little more than 3%, about 4%.
Sure.
So about 4% of your cost is what you're capturing as depreciation expense each year. The beauty of real estate is that it really doesn't depreciate. Now you have to maintain the building, but as we've seen in our market, everything's going up.
Yes, absolutely.
So the values are going up on an asset that for tax purposes, you're able to depreciate. And it gets more complicated and more interesting. So the IRS also has these code sections like 179 that allow you to depreciate certain assets over a much quicker period of time, sometimes all in 1 year. So all those real estate agents that are driving around in Range Rovers right now, they did that because they're able to write off the purchase of that all in 1 year through that section 179 or bonus depreciation.
All right. This isn't totally real estate related, but bringing up real estate agents, what constitutes a car you can purchase to write that car off?
So good question. The IRS has rules
in place. A little extra in there for us.
Yeah, a little extra. So typically it is a vehicle that has a weight of 6,000 pounds or more. Gross vehicle weight rating, GVWR. And if that's 6,000 pounds or more, then it qualifies for this bigger depreciation deduction. If it's less than that, then it's still actually a pretty significant depreciation deduction, but it's less.
Okay, good to know. I was double check on that. Okay, so deductions, depreciation, all of that's amazing.
It is amazing.
There's like, you could do probably multiple segments just talking about that. Those are really important aspects. So let's talk about, before my next question, you kind of brought something that made me think. Do you think that there's, from a deduction standpoint, and being in a resort town like here where a lot of people, including myself, have vacation rental properties. Do you think that there's a pro and con versus buying long-term rental versus short-term rental? And what would be your advice to somebody asking you that question if they're planning to dive into one or the other?
Yeah, no, that's a great question. Well, so when you look at it from short-term rental versus long-term rental, the underlying value of the real estate is going to do whatever it's going to do.
Sure.
Right. So if you buy a house, in 10 years, it's going to be worth whatever it's going to be worth, kind of regardless of whether it's short-term or long-term rental. And so really, if you want to make the decision on short-term versus long-term rental, it kind of comes down to two pieces. One is economic. Short-term rentals tend to generate more revenue.
Yep.
And so that's what we see, amongst our client base and the people who we talk to around here. They also come along with more headaches, right?
Yes.
So more maintenance, more headaches, more things to manage. So it kind of depends on who the owner is. If the owner wants to take on those additional responsibilities of maintaining the home and dealing with lots of different renters that come through, then they can probably make more money with it. The long-term renters tend to be more stable and, assuming they pay the rent every month, it's kind of cruise control.
I call them crock-pot investments.
Yeah,
Set it and forget it.
That's right. That's
Good.
right.
But so, okay, that's a good answer. That's helpful. The other thing too is like you can take these properties, and this is, we might have something to add, but with a vacation rental property, you can build that book of business out and almost sell the business with the property, where you say, hey, we've grossed $100,000 last year, we're on pace to do 150 this year, and then we've got X amount in bookings going into the future year.
Sure.
A lot of people I work with will buy properties based off of the financials and the numbers, not just the asset in particular.
Yeah. Definitely starting to see more of that.
So with that, let's talk about passive income and cash flow. So like, tell me passive income. Everybody hears that, make money sitting on the beach in Hawaii, collecting real estate checks. I have yet to figure that out, but talk to us about passive income from real estate and how that's taxed, and maybe just add your spin on that.
Sure. It's interesting because I just did a talk this weekend about residual income, right? And the same type of concept of passive income versus residual income.
Is passive income the same as cash flow?
Kinda. Okay. Yeah. So from a tax perspective, it's different, and we'll talk about cash flow in a minute. I think the notion of passive income or residual income being this thing that is like a crock pot that you just set it and forget it is a little bit of a misnomer. It's something that probably doesn't really exist in the way that most people think it exists. If something is making you money, you have to pay attention to it, and there's some work involved in making sure that it continues to make you money. So I think rental property clearly falls into that same category. The reason it's called passive income from a tax perspective is because that's the way that the IRS treats that income. So from the IRS's perspective, things like rent income and royalty income and even certain investment income like interest and dividends are deemed to be passive income, as opposed to active income, which is like your W-2 income or your independent contractor income, or the thing that you do to earn money. And so passive income is treated a little differently from a tax perspective. It's subject to the same tax rates, but it has this rule associated with it that says that if you generate a passive loss, you can only deduct that against other passive income. So in the case of a rental property, let's say you had two properties and one was losing money and one was making money. You can take the loss of the one losing money, tax loss, and we got to remember that depreciation could take a property that is cash flow positive and make it taxable negative. We can talk about that more in a minute. Okay. But you have a tax loss on one property. You can take that tax loss, and apply it against the taxable income of the other property, and those two net out.
So they offset one another.
I
like that.
There are some limitations.
Sure.
So if you have two properties that have passive losses, and you don't have any other passive income, then depending on what your income level is, you can deduct up to $25,000 a year of those passive losses against your other income, which is nice. So if you have a W-2, $100,000 a year, and you have some passive losses come from real estate, you can use those losses to offset the taxable income from your W-2 to pay less tax every year. If your income is greater, then it works out to be $175,000 for married filing joint, then you don't lose that. You just can't take it this year. It carries forward. And so there's a form in your tax return, some of you may have seen, called an 8582, that captures all these passive losses that have been deferred and they carry forward to a future year. And then you can deduct them all in the year that you sell.
Okay, so you might want to like rewind that because no. I'm saying that's really good stuff,
Yeah.
and a lot of people don't realize that they're getting this information
Yeah.
for free when they might need to pay you big bucks for this or
That's
somebody else. So like, you might want to rewatch this again if you're thinking about investing in real estate, or even if you are actively investing in real estate. Now could be a good time to restructure everything because I know lots of people with 5, 10, 15, 20 different properties, and most likely they're set up like this, or they may have never even heard this and just been doing it very old school. So
Right.
that was those were some good nuggets right there.
Well, let's go one step further with it.
Okay, let's go.
Because the next question is that I get all the time is well, how do I take it from being passive income to active income, right? Because I don't want to be subject to these passive activity loss limitations.
Sure.
And there are some people out there that qualify for this that do not know that they qualify for the election to treat their income as active, their rental income as active. So there's two things. This is all covered in Section 469 of the Internal Revenue Code. And I'm not going to quote this to you because everybody on this video would go to sleep. But basically what it says is that there's two things that you can do. One, you can make an election to aggregate all of your rental activities.
Mm-hmm.
So for those of you out there who have more than one rental property, maybe you have 3 or 5 or 10 or 15, you can aggregate all of those into one activity. It actually makes the reporting much, much simpler. You can put it all on one Schedule E1 and group all of the revenue and the expenses together. Well, why would you want to do that? You would want to do that because the second part of this code, Section 469, talks about qualifying as being a qualified real estate professional.
Mm-hmm.
Okay, so you're clearly a qualified real estate professional. You're a real estate broker. You know what you're doing.
I'm not a broker.
Oh, sorry, agent.
I own a brokerage, licensed agent though.
But most
Yes.
of what you do all day, every day, 80 hours a week or 100 hours a week is real estate, right?
1000%. I love it.
So there's 2 rules to be a qualified real estate professional from a tax perspective. One is that it has to be at least 50% of what you're doing.
Okay.
Right? So you may have other things going on, but if you're spending more than 50% of your time on the real estate activity, then you've satisfied rule number 1. And rule number 2 is that you have to spend at least 750 hours a year working in real estate activities. The beauty of using that first provision and grouping all of your activities together is that now you have one activity that you can say, I've worked 750 hours a year on this one activity, which is an aggregation of all of my real estate. And now I meet both tests 1 and 2 because it's more than 50% of what I'm doing all over the place, and it's 750 hours a year on this activity. Now the income or the losses that are coming from this rental activity are no longer passive and they're active. And where we see this really, really work well is typically in a couple where one spouse has very high income.
Sure.
$300,000, $400,000, $500,000, $700,000 a year. They've never been able to deduct real estate losses or rental income losses that typically come from the depreciation on it. And the other spouse is the person who's actually managing the rental business,
Mm-hmm.
right? We see this all the time. And those tax returns come to us and we see that prior CPAs have never taken advantage of this code section 469. And we're able to treat the one spouse that's managing all the real estate as a qualifying real estate professional, capture those losses, offset the big W-2 income, and save them a bunch of tax.
Wow.
It's pretty powerful.
That's really cool.
It is.
I mean, you're very educated and savvy with all of this. And
Yeah.
So aside from these questions, what made you take the time to really get educated and learn that? Were you personally doing it, or do you work with all these people, or how did you get so knowledgeable? Obviously, this information's out there for everybody,
Sure.
but I don't think many people are as educated and on such a high level as yourself.
Yeah, there's probably 2 or 3 answers to that question. So number 1, yes, I invest in real estate.
Cool.
I own real estate. I like it. And so clearly I want to have it structured the best way possible for me and my family. But primarily most of the knowledge really comes from looking into all of these situations for particular clients over the years.
Gotcha.
Right? And I'm just passionate about saving people tax, right? So if I need to go read Code Section 469 in its entirety and all the regulations that support it and all the rev procs that support it, then that's what I do. Because I want to figure out how to structure this thing in a way that is going to save people the most tax.
That's
And
powerful.
that's
That's
what we
awesome. Okay.
Yeah.
That's really powerful.
Yeah.
Very cool. Okay. Next question. Capital gains tax. So short-term capital gains, long-term capital gains. What are those?
So let's just talk about gain. So if we go back to this idea of cost basis and You have cost basis and you have net cost basis. So when you buy a house, let's say you pay $300,000 for it, and let's say you own it for 10 years, right?
Okay.
Over 10 years.
And we're talking investment property, right? Not
investment
personal.
property.
Okay.
Yeah, not personal residence,
Sure.
but we'll break that down in just a minute. You may capture, I don't know, whatever the number works out to, $1,200 a year in depreciation. And so over 10 years, maybe you've captured $30,000 or $40,000 in depreciation.
Sure.
You paid $300,000, you've had $40,000 in depreciation, you've got $260,000 now net cost basis or adjusted cost basis. From the IRS's perspective, this is what your current cost basis is. So if you sell this house, cost basis of $260,000, let's say for $400,000, okay, then you've got $140,000 gain. Okay.
Okay.
So the difference between what you sell it for and what your cost basis is, that's your gain. And yes, you can adjust your sales price and your basis for whatever your costs are. So the good news about real estate agents, everything you pay to a real estate agent, all tax deductible. How about that?
Love that.
Yeah, it works out.
Charging more.
Okay. So you reduce your gain by the cost of the sale, and you end up with the taxable portion of the sale. Now, what determines whether it's short-term or long-term is how long you've actually owned it before you sell it.
And I think
Right.
a big reason I'm asking this question is because you've got these people who buy and hold,
Yeah.
and then you've got these people who are
Flippers.
flipping houses.
Yeah.
And those people that, they buy the house for 200, maybe put 30 in it, sell for 300. They're not just making 70 grand or whatever the profit is. Like, they're paying some more in taxes.
More
correct?
tax, yeah.
Okay.
So the short-term, if you've owned it for less than a year, it's short-term. Capital gain, even though it's capital gain, is subject to ordinary income rates.
Okay.
So if your nominal tax bracket is 32% and you recognize a short-term gain because you flipped a house, then you're going to pay tax on that at 32%. Whereas the person who's bought it and held it for at least a year is going to be subject to long-term capital gains, which is either 15 or 20% depending on what their tax rate is. So a much lower capital gains rate for long-term capital gains than for short-term capital gains.
Okay. So that takes me to the next question, which I know you might not specialize in or have some, but I know you definitely know enough to be dangerous, is what's a 1031 exchange? A lot of people don't know what that is when we talk about it and we're structuring deals for people or they're selling something. And I think a lot of people leave an insane amount of money on the table with not understanding what that is. So could you break down what a 1031 exchange is?
Absolutely, yeah. We've only done like hundreds of them.
Okay, perfect.
Yeah, we've done lots of them. What's interesting about 1031 exchanges too is that you have a traditional 1031 exchange. You can do a reverse 1031 exchange. You can do a build to suit 1031 exchange. You can do a reverse
We might
build
need
to
another
suit
video.
1031 exchange.
Okay.
Yeah, we could literally do another hour on 1031 exchange.
Simplify it for the normal person, because I think I call you every 3 to 4 weeks about 1031 exchange questions.
Yeah.
And I learn like an insane amount every time on that 5-minute call.
Right.
So break it down for us.
So the idea, and first of all, it's worth stating that a 1031 exchange is only available to real estate. Like it
Yes.
used to be available to other assets.
Oh, really?
But now it's only available in real estate. But the long and short of it is that if I have a property I want to sell and I want to take those proceeds and invest it in a second property, the Section 1031 allows me to assign a 1031 agent to hold those proceeds. So basically act in my place as the seller, hold those proceeds, and then invest those proceeds into the second property. And the benefit of doing that is that the gain that I have on the first property rolls into the second property without me paying any tax on it.
So you pay no taxes on the profit as long as you roll it into a property that's been identified.
As long as it's a property that's been identified and as long as you're spending as much as you were selling for.
Okay. So you sell the house for 400, you can't go buy something for 200. You got to buy something that's 400 and
400 or more.
400 or more. Okay.
And the most important part, and I see people make this mistake all the time, is that they come to me and they say, I just sold this property and I want to do a 1031 exchange. So that doesn't work. You gotta do it beforehand. You gotta assign your 1031 agent before you sell.
So if you've got a contract on it but haven't sold,
it's not too late.
It's not too late.
You can do
have
the
that window
1031.
to figure it out.
That's right.
Okay.
And they're very reasonable. Like the 1031 fees are not very expensive. They're very reasonable. There's a lot of good parties that act as 1031 agents. I've never heard of a story of the 1031 agents running off with your money. They're all insured with fidelity bonds and all that kind of stuff. And it's an easy process to go through.
So what are the benefits of that aside from saving money in taxes? Is there anything else on top of that? Do you think it helps someone do more if they're like, hey, I built this portfolio of
Well,
single family, I want to roll it into multifamily or buying buildings? Like,
yeah, it's a
what
good
do you
question,
see
and
typically?
we do get that question a lot. It's like, what can I invest into?
Mhm.
Because if I'm selling a residential rental, do I need to buy a residential rental?
Sure.
So you're not actually limited. As long as it's real estate, it qualifies. You could sell a residential rental and buy vacant land.
Okay.
Okay, it just has to be real estate. But the benefit of it is that you're using pre-tax dollars to invest.
Okay.
So if you were having to pay, if you sold a house for $400,000 and let's say your gain was $100, and you would have to pay $20,000 in tax, you'd only have $380 left to invest, right? So now you've got the full $400 to invest. So it allows you to compound your money over time more, right?
That's awesome.
Because it's all in a pre-tax environment.
We're playing chess, not checkers over here. I mean, that's pretty cool. Okay, so on top of that, 1031 exchange, you take money from a sale, put it into something else tax-free. And this might be a question that's not in your wheelhouse, but maybe you have some additional input on it. I think it's maybe more of a lender question, but we've been seeing people with these really low rates. They've got tons of equity in their home and they're doing what's called a cash out refi.
Mm-hmm.
And you can pull that out tax-free as well and do some pretty cool stuff with it. Do you have any advice or input for people in that type of situation? Because we've never in American history, you might not know this, but we've never in American history have seen more equity in homes than ever before than right now. So a lot of people who have maybe been living in their home at a 4.5-5% interest rate, it's almost paid off. They can go and take, I think, up to 80% out of the house, pull it out tax-free, and then do whatever they want with it. Are you familiar with this?
Absolutely.
Okay.
Yeah. I mean, I've done it. I've had clients do it. The beauty of it is that when you do the cash out refi, it's not income to you, right? So yes, you're pulling the equity out of your house, but you haven't sold it. So you're only going to pay tax potentially and recognize gain when you sell an asset. Pulling the cash out through a loan is not a sale, and therefore it's not taxable to you. So being able to utilize that equity to invest in other things can certainly be part of a financial plan for somebody. I mean,
cool.
that could be advantageous.
And I think to those people that are out that want to flip property, I'm doing a flip right now. You've helped me with it, and that's not my bread and butter. I wouldn't say I'm a flipper at all. But what I think is the smartest route to do is you go buy that house cheap. You know what I mean? That needs money put into it. You buy it, you rehab it, you get it reappraised, you pull all the cash out tax-free that you invested it, keep the property as a rental property, and then go do it again with another property.
Yeah. So can I throw a caveat into this? All right. So the caveat, having been through some ups and downs in the real estate market for the last 25 years, is to make sure that you've got enough cash to satisfy your debt obligations through a downturn. Right? So the people that I saw get hurt were the people who did cash out refis, were extremely leveraged on all of their properties and had no cash. Real estate rich, cash poor. And when the downturn happened, they didn't have enough cash to continue making mortgage payments, if they had a renter drop off or whatever. So I think the key to the whole thing is I think the strategy that you're promoting right now is a really good strategy. I think a lot of people can make a lot of money doing that. I think the key is to make sure that they look at what is their debt service obligation and make sure that they've got that money set aside for a year or 18 months.
1,000%.
If there is a downturn, they can carry it through and they're not in a position where they're just, tight on cash.
Yeah, don't over leverage yourself. I totally agree with that. Okay, so that's really cool. Let's talk about how we should be purchasing investments. And I want people to know too, this video is for someone that's never even invested in real estate but's interested in it.
Mm-hmm.
You should or should not be buying a rental or income producing property under your own name. It'd be advisable to buy it under an LLC or in a trust. I mean, what are you telling your clients on how to purchase property and deed it into? How are you supposed to purchase property appropriately?
Sure.
That's best advantageous from a tax standpoint.
Yeah. So this is a really good question, and a little bit hard to answer because it's one of those it depends answers.
Maybe get attorneys involved, that kind of
Certainly
stuff.
Get an attorney
Everyone's
involved.
situation's different.
But I think we can talk through some of the reasons that people use an LLC or don't use an LLC. And so the advantage of having an LLC, right, a limited liability company, is that when you make an investment into the limited liability company, your risk of loss is limited to what you've invested in that company.
Okay.
Right? So the place where we see a lot of people use LLCs, let's say, is you're buying a commercial property, and you would want to own that commercial property in an LLC. Why? because a commercial property typically has a little bit more risk associated with it. You've got multiple tenants in there. You know, if we're in a building like this, you know, somebody gets hurt, you get sued. Instead of you being sued, the owner of the building gets sued. If the owning of the builder is the LLC, then they typically cannot penetrate through the LLC and sue the individual who owns the LLC.
Okay.
Right? So it helps you protect your personal assets. The kind of the buck stops at the LLC, and there's caveats and exceptions to all of this.
Sure.
That you definitely want to talk with an attorney about. But the clients that I've worked with who have lots of personal assets and are purchasing a piece of real estate, they're going to want to look at how much risk does that piece of real estate have. If it's a long-term residential rental, you know, nice lady, you know,
Pretty
with
minimum.
a cat, you know,
Sure.
and not doesn't represent a whole lot of risk, then they may just own it personally. If they're buying a multifamily complex and lots of renters coming and going, or an Airbnb, lots of renters coming and going, a commercial property, then they may choose to put it in an LLC so they have that extra layer of protection in there.
Great. So definitely consult with an attorney.
For sure.
Everyone's different. The other thing to add on that, which a lot of people will give this advice, and you might have given it to me, but wherever I heard it, you buy your first house, you know, primary house, put it under your name, whatever.
Right.
But that investment property, buy it in an LLC. But if you go buy a second property, buy that one in a separate LLC, and you set them up continuously as different businesses and entities. Is that accurate?
Certainly.
Okay.
And I would just say that it's just kind of all based on facts and circumstances in wherever each person is with their own portfolio and what they're trying to do. But it's a good segue into what I wanted to talk about with
Sweet.
respect to the three kinds of investment. Because the first question was about the tax advantages. And
Sure.
I think it's important to understand which one of those things you're looking at. Residential rental or just investment property, and then commercial rental, and then personal residence.
Sure.
So from we've kind of covered the residential rental. I feel like that's pretty clear in terms of why people would want to do that and what the tax advantages are.
1,000%.
Commercial property is probably a little, especially if it's commercial property for your business. Okay.
Okay.
So I'm running a CPA firm. I buy a building for my CPA firm. The depreciation that I can take through that, especially if I do this thing called a cost segregation study, where I break out what the actual costs of the building are and what part of those costs go to support tangible personal property, I can capture massive depreciation, much more than the 3 or 4% that we just talked about.
And you helped, you know, myself, Sadie, DJ, and Lindsay do this with the building we purchased for us. I mean, it
worked pretty good, right?
Yeah, I mean, it was incredible, guys. It's a big reason I brought him in. Like, you've really helped Sadie and I get our business in line,
Right.
and help us plan for the future through real estate.
That's right.
So everything you're saying is really cool and some really good nuggets.
Yeah. And so commercial property, again, it has this
Good high five.
great benefit of investing in a property that's going to appreciate in value, but you're capturing massive depreciation that offsets the income of your business. People, whenever the report came out, you know, that Trump had only paid $750 in tax, people were like, how? Right?
Yeah.
Well, the answer is almost all of his investments are in commercial real estate, right? Commercial real estate generates massive amounts of depreciation, big tax losses, but the underlying value of what he's investing in is going up in value, right? So it's brilliant from that perspective. And then on the personal resident side of things, there's so many people who don't know about the Section 121 exclusion, the personal resident sale exclusion. And the way that works, if you've lived in your home for 2 of the last 5 years and you sell it, you are able to exclude up to $250,000 per person, $500,000 per couple of gain from your tax. So you could buy a house for $300,000, live in it for 2 years, live in it for 20 years, whatever it is, but at least for 2 years, and then sell it for $500,000, and that $200,000 of gain, you don't pay tax on that.
Wow.
That's excludable from your income. It's
I
huge.
mean, that's just great from a home ownership standpoint.
Right.
Okay.
Yeah.
Changing gears, I only got a couple more questions. Opportunity zone. How much do you know about opportunity zone? People love to throw that word out there.
Sure.
They say there's amazing tax benefits of it, all this random stuff, but like, what is it?
Sure. Yeah, it's a great question. All you have are great questions.
I tried. I've worked really hard on these questions. I've been trying to stump you, and I haven't yet. So
Opportunity zones, first of all, they're super complicated. The simple version is that it allows you to sell an asset. It doesn't even have to be real estate. It could be a business sale, and to be able to roll that gain like a 1031 exchange into another investment. And that investment has to be in an opportunity zone fund. So opportunity zone funds are created to invest in real estate that's located in very specific opportunity zones all over the U.S. And then the benefit of doing that is that you don't pay tax on the gain that you realized first whenever you rolled into the zone. That gain rolls into your investment in the opportunity zone, and that's tax deferred. And then depending on how long you own that investment, I think you have to own it for at least 5 years, you can exclude up to, I think the number is 10 million of gain from your investment in the opportunity zone. And then you've deferred the tax that you pay on the first gain. So that tax doesn't go away, it just gets deferred. But the tax on the gain from the actual opportunity zone investment can be excluded.
Sure.
So it's a double dip. Like you get the benefit of the 1031, plus you get the benefit of an exclusion. And obviously the whole goal is to incentivize investors to invest in opportunity zones, which are places that the government has identified as needing more investment.
Are they creating more opportunity zones?
Not that I'm aware of.
Okay.
And I'm almost convinced at this point that there were probably some lobbyists who knew where they wanted to make investments, and so they just created the opportunity zones there to make this work. Because honestly, I haven't seen anybody really take advantage.
People love to throw the word around, and that's a big reason I asked, is because I just wanted to get your 2 cents on it, because people throw that word around, and a lot of people don't really understand what it is. So
they're hard to find. I mean, we have opportunity zones here in this town. I've talked with some people about the opportunity zone in Palatka, but there needs to be a fund. Right, so it's not as simple as just buying real estate in the opportunity zone. You have to invest in the opportunity zone fund, and finding those funds that make sense and are going to be economically good has been very challenging.
Okay, so that pretty much summarizes everything I wanted to cover. We're going to wrap this up, but for me personally, I work with a lot of small business owners who are looking for ways to offset their taxes by purchasing real estate. Explain to someone new why they would want to do something like this. And how would you help them strategize?
Sure. I mean, I think, like I said before, I think it's an important part of people's portfolio. I think people need to go into it eyes wide open. Like, unless you own a vacant piece of property, there's going to be some work involved.
Sure.
Just like owning a home requires some work. There's a honey-do list. But if you're the type of person who wants to invest in their future, invest in assets that you can, kind of control in some way, and you have a little bit of skepticism sometimes about the stock market and those kinds of assets, it's a fantastic asset class. And there's clearly lots of tax benefits, as we've discussed on this video.
I feel like just really scratched the surface with a lot, but I'm hoping this was really informative for everybody. So real quick, we know your business, but tell them, who is your ideal client, and are you still looking for new clients? Because I know it's not just you. You've got a business and people that work with you and for you and partners. I mean, who's your ideal client, and are you still looking for new business?
Yeah, well, we're definitely looking for new business. We are focused on working with entrepreneurs by and large, right? So that said, we do trust and estate work. We do high net worth client work. But my passion, hopefully you can tell, is that I love working with entrepreneurs. I love helping people take ideas and grow them into a thing. We're just passionate about helping entrepreneurs be successful with their business. A lot of times that involves tax and accounting. Sometimes it's technology. Sometimes it's marketing. Sometimes it's HR. But who knows what it is? We do it all. But whatever it takes to help entrepreneurs be successful, that's what we're all about at Tembo.
Well, I can say Ben has been definitely super helpful with Sadie and I as we've been growing our business. I mean, that's what you said is very authentic. You're the real deal. We're in Saint Augustine. What's your favorite thing about Saint Augustine?
Oh, goodness. The restaurants are great. The people are great. I do love the fact that you can, like, if you've been here as long as I've been here, we can basically go anywhere in town and know somebody. So it's a small town, but with access to lots of attractions and restaurants and big town things. It's awesome.
Ben, thanks for hopping on.
Absolutely.
Appreciate it. What's the best way for them to reach you?
TemboCPAs.com.
Awesome. We'll make sure we include that in the video. Guys, if you've got any additional questions, comments, concerns, drop them in the comments. If there's something we didn't cover, maybe we get them back on, get them answered for you. And if there's obviously anything you want to talk about from a tax standpoint, call Ben. From a real estate standpoint, contact the Newcomer Group. And thanks for watching.